Hey, what's going on, guys? My name is Daniel, one half of the Kwak brothers, and today we have a very, very special guest. A lot of you may know who he is. I myself am a very big fan. We have Mr. Jason Hartman, who obviously is an expert on macroeconomics, real estate, and he's talked about awesome topics as of recently, such as inflation and the supply shortage and the housing market. So, what a pleasure to have you on board. Thank you so much for coming, Jason.
Daniel, it's great to be here, and I'm a big fan as well. You guys do great work. I love your content, love your videos. So it's a real pleasure.
Yeah, thank you so much. So I'm just going to get right to it. And I'm going to ask the question that a lot of people have been asking me. We've addressed it in our YouTube channel, but I want to hear your opinion. What do you think our home price is going to do in 2022? Should people be worried?
No, I would not worry yet. There will eventually be a correction. However, it is not right around the corner. So do not worry about any big crash coming anytime soon. Now, granted, I always say that it's very risky to make predictions, and we're in a situation where the government is running the economy. The government and the Fed, they are different, so since we have these central planners running the economy, we can't just talk about market forces as we make these predictions, right? If I could, I think a lot of us can predict what the market will do pretty well, but can we predict what the central planners will do? Not so well. And that's the one caveat, right? Because if the Fed tomorrow decides they're going to raise interest rates to 17%, of course all bets are off, right? You can't see that, but I don't see that happening. And inventory is extremely low. And I think we should start by talking about inventory maybe. So I'll let you take it from there though.
Yeah, no, that's a phenomenal question. And that's actually something that Sam and I posted a video about recently, how, we believe as well as you do that, there's not a lot people should be worried about. But let's talk about inventory, because obviously, it's very short right now. And not only that, but the time it takes for people to close on homes is faster than it has before, which I think a lot of that also has to do with technology. But for you, Jason, aside from, issues such as we have with construction and labor shortages and supply chains issues, what are some other things that you believe will cause a inventory shortage moving forward in 2022?
Well, it's simply population versus supply. And, we've got this generation, millennial generation, moving into their prime home buying years. And we've got a situation where the home builders have just not been building enough homes coming out of the Great Recession. And this is particularly acute in the entry-level market. So, for example, and I'll just share my screen here and show you. I recently had the founder of Altos Research on my show, and this chart shows you that the inventory starting the year is literally the lowest it's been since they started tracking this stuff on a per capita basis. So, home inventory versus population is at just under 300,000 homes for sale. Now, just to give people a perspective of where it should be, most experts will tell you, and experts never agree completely, okay? So we got to understand that. But they'll tell you that inventory to be in a normal market would be about 3 to 5 times this amount at this time of year. So it's like going into the grocery store and seeing the shelves 1/3 to 1/5 bare, nothing on those shelves. And so now that's just overall housing inventory. But when you look at the housing inventory in terms of the entry-level market, it is dramatically worse. Dramatically more acute is this problem where they just have not been building entry-level homes. There's no profit margin in them. The builders simply cannot deliver $150,000 homes anymore, not even $200,000 homes. If you look at the low-end home builders in the country, KB Homes and DR Horton, they're famous. They've built huge businesses for decades on supplying entry-level housing. Entry-level housing, the definition now is $400,000. So it's just completely changed.
Yeah. And as a matter of fact, by the way, before we move forward, If you're a viewer watching this video, I'd highly recommend watching that episode. I watched that episode. I thought it was phenomenal. A lot of really good data. It was a good one. So if you're watching, I'd highly recommend you guys go ahead and check that out. Which, by the way, where can people find that episode, Jason, before we move on?
Which episode are you referring to?
You had an interview with the founder of Altos Research.
Oh yeah, well, it's on my YouTube channel, and it's also the audio only is on my Creating Wealth podcast. Yeah,
absolutely. Okay, so going back, you brought up a really good point. How the profit margins aren't there for builders to be building these $200,000 and sometimes even $250,000, $300,000 homes. And a lot of surveys and studies show that the biggest obstacle and the bottleneck for my generation, the millennials, to buy homes is the down payment. It's not necessarily interest rate or the financing or the credit. It's the down payment. So for you, looking at those two things, and I think you and I are on the same page in terms of saying, well, we don't know if construction costs and labor is going to go down anytime soon. Therefore, that profit margin isn't going to get as big as we hope for these builders to start building these entry-level homes. How long do you think that's going to be kept up for, especially with my generation who has such a challenge in coming up with that down payment?
It is going to be a problem that persists for a good 2 years, if not longer. And just to make matters worse, okay, as if it wasn't bad enough, right? I mean, the thing the government needs to do is help suppliers supply more homes. That's the way to solve the housing shortage. It's not to focus on creating more housing demand. And they do the complete opposite. Instead of relaxing zoning laws, now, of course, that's a local government issue, not a federal government issue, right? But government in general needs to relax zoning laws to allow builders to build homes more easily. They need to relax environmental laws. They need to relax some of the laws for the type of construction they require. I'm in Florida, so this is hurricane territory, right? And the building codes basically require builders to build these homes that are as sturdy as a tank. The home I purchased in Florida when I moved here about 4 years ago, I can't believe this place. It is bulletproof. I mean, the windows are like this thick, and it's all concrete block construction. I mean, it is sturdy. And still, my insurance is super expensive. I don't know why. I can't imagine you could blow this house down. It's just overkill. And what it's doing is it's pricing people out of the market with this high cost. So maybe we don't need super high quality construction. Maybe we need to give people the option to have some cheaper construction so they can afford a house, right? Of course, everybody wants the nicest stuff and the safest stuff, but there has to be a balance between pushing people out into sleeping in their cars or on the street, or forcing them to live at home until they're 45 years old, right? So what the government did to make matters even worse for these buyers is this, and it's on the screen, but basically they increased the loan limits. So what they did is they took gasoline and they threw it on the fire of the housing shortage by increasing the conventional loan limits by 18% and the FHA loan limits, depending on where you live, by about 15%. So now in some markets, you can buy a $1 million house almost with 3.5% down. All that will do is instantly allow sellers to just increase their prices. It's crazy, it really is crazy.
Yeah. And it is frustrating because, you look throughout history and you look at some of the biggest bubbles that we have right now. I mean, look at what happened with Bush when he started instituting the home ownership. He wanted the home ownership rates to rise. And that, in my opinion, was a pretty big factor in contributing to what happened in 2008. And same thing with Obama when he said, hey, everybody needs to go to college. And now all of a sudden we have this giant bubble with student loans. I mean, I have thousands of friends who, they just can't get out, because of the interest that they're paying. And, when I hear proposals from our current administration of wanting to do a $15,000 credit for, tax credit for buying a home up front.
Right.
I mean, it's just stuff like this. I get it. I hear you.
Yeah, you are absolutely right. There is no shortage of housing demand. What we need to do is focus on the supply shortage and make it easier to create more supply. And the student loan thing that you just mentioned is so perfectly aligned with this example. Because if you think about it, my mother went to college and she went to Berkeley, which is an excellent school academically. It's a little crazy politically, of course, but she was able to just have a job and pay for her own college without no one would have taken out a loan. That was the craziest idea ever. And then in the 70s, the idiotic government came along and decided through Ginnie Mae, we should start insuring student loans. So guess what? A whole bunch of lenders got into the student loan business because they said, hey, we have a risk-free business here. We can go and make these loans, and if they default, the government will backstop them. So basically what they did is they started making student loans, and what did the colleges and universities do? They saw a tidal wave of new money coming at them, and their prices for tuition went up at 3-4 times the rate of inflation. They just ripped people off, and they have now ripped off literally 2 generations, if not 3 generations of people that they have created student debt slaves through the student loan debt industrial complex. It is disgusting what they have done.
Yeah. And I remember, go ahead, please. Yeah.
Yeah. Well, I'm just saying people should be able to go to college if they want to. And I don't think college is necessarily anything that should be required, right? That whole idea that everybody needs to go to college is just dumb on its face, right? That doesn't make any sense. But anybody who wants to go to college, hopefully they're going to get a STEM-oriented degree that actually is useful and, people will hire you for, right? But if they want to go to college, fine. They shouldn't have to leave with a loan. They should be able to go to college, finish college, and have a fresh start. Now, basically, they leave with a mortgage where they have to pay this mortgage, this student loan, for a decade or 2, yet they didn't get a house included with it. It's terrible. It's criminal what they're doing.
Yeah, but I don't know about you, Jason, but I think the person who got a degree in gender studies should make $250,000 a year. Don't you? Right?
Yeah. It's funny you mentioned that, Daniel, because I've never seen a job posting. I've searched all around Indeed. I don't see anyone offering jobs for feminist studies or underwater basket weaving or any of these useless degrees.
Right. Oh man. Yeah. I actually remember being in high school, that's when Obama had his first term and they really pushed this whole, hey, everybody should go to college. Everybody should go to college. And I think now that it's, about 5-10 years later, we're seeing the results of that. And that's the byproduct is we don't have that many young people in the trades anymore.
Yeah.
And the average age, I think, of somebody in that's working the trades is something in the mid 50s, right? I think below 50s.
Yeah, you're right.
And it's crazy because even going back to the housing market, my generation and then the generation that comes after us, Gen Z, is the largest generation even after us. And, we're the largest generation after, the boomers and Gen X.
Yep.
So, in talking about housing, the demand, to your point, is not going away anytime soon. No. If anything, there's going to be more people entering the market. And unfortunately, I think because of what we're talking about with the cost to build and these big companies, these home builders not able to supply the affordable housing, the starter homes, I think that leads us to rent. And you said it, in many episodes that I've listened to recently, the rent potentially skyrocketing the next 2-3 years. And I don't think guys like me and you want to see that. We want to see people being able to, have a place to live with their kids and be able to put food on the table. So for you, my question is when it comes to rent prices, because we talked about home prices, how do you see that going up in 2022?
My prediction that I am now public with, so I might as well share it with you, is that we will see an 8% increase in rent this year. Rents will go up by 8%, and I also predicted that housing prices will increase by 12%. So My predictions may or may not be too optimistic. We'll see what happens. But what I want to remind everybody is that in the real estate world, all real estate is local. There's no such thing as a national market. And you can divide markets up into three major types, though, I believe: linear markets, cyclical markets, and hybrid markets. And the linear markets, and most of them have really all become hybrid by now because the market's just been on fire. But those are the markets we like to invest in. We shy away from these cyclical markets that are sort of the high flying trophy markets around the country. They're the west coast of the US, the expensive northeastern markets, or South Florida where I live, or I just live just north of that, but like Miami, Fort Lauderdale, just way too expensive, those markets. And around the world, there are places like Dubai, Paris, London, Hong Kong. So these are markets that never make sense to invest in. They're always speculator markets.
Yeah. So in talking about, your rent prices, the prediction is 8% increase, home prices at 12%. I personally think you're not that far off. I think it's very possible. Now, in your opinion, what do you think is going to happen with a lot of this financial strain that's going to be happening for renters in 2022? What is the leading cause of that? Because our mutual friend George Gammon mentions the invisible hand, that terminology.
Right. Yep.
But so for you, what do you see as the byproduct of all this strain of rent prices continuing to go up?
Well, Adam Smith's invisible hand is a brilliant idea, right? And that is always playing in the marketplace. And there are probably two. Look at economics. The study of economics is simply the study of how to allocate scarce resources. And the market does that better than the central planners ever can do it, right? And if you look at what happened in the Soviet Union and how they just didn't know how to price things, they had a pricing office basically, and they basically looked to the Western world for price signals so that they could figure out how to price things. Can you imagine such a dysfunctional economy that you'd have to go and look at what the US is doing to figure out how to price your bread or your whatever, right? It's absolutely silly. But that invisible hand comes into play and it works very well. And there are two markets where scarcity is particularly acute. One is real estate, because it's just inherently scarce. The land supply is limited and the building costs are very high. And as you mentioned before, there are a lot of shortages. But the other one, interestingly, and try not to laugh too hard, but it's true, is the dating market and the mating market, because that is incredibly scarce market, right? Everybody has their certain profile of what they're looking for. And I think it's a pretty good comparison, actually, because there are very limited, when you look for a house or you look for a mate, right? There's a very small number of sellers, if you will, who have what you want, right? And so it's always a game of compromise. And, for whatever it's worth, the people who are willing to compromise and make decisions maybe a little more quickly versus those who are holding out for the perfect thing, right? They tend to be happier, I think, in life, right? Because, if it's a house, right, not a mate, if it's a house, then you're going to get in the market, right? And you get in the market and the first house is never the right house. It's never the perfect house. That's why they call it a starter home, okay? And there's a show called Starter Wife, okay? Right? So, it's kind of funny, right? And so they get in the market and then they get to take advantage of all the economic benefits of home ownership. And they ride it, and then they get the next house and the next house. And once you're in, you can move up more easily because you're trading equity. And that's, by the way, why the Housing Affordability Index, which is a good metric, but certainly not a perfect one, it's published by National Association of Realtors. The Housing Affordability Index doesn't really help people evaluate for those who are already in a market that already own a property who are trading equity.
Yeah.
And I see you nodding your head. So if I may, I'll just share an example of this.
Yeah.
Because the Housing Affordability Index, and I think it's important to talk about because it's a pretty good index, but not great. What it does is it measures the median mortgage payment versus the median income in a given area. And so, for example, where I spent most of my adult life was Orange County, California, Southern California. This is a beautiful area. It's a very expensive area. I lived in Irvine. I lived in Newport Beach. Great place. Super, super expensive. And if you look at the Housing Affordability Index, it would tell you that, nobody can afford a house, right? Basically, because they can't, based on that index. But what it doesn't tell you is all of these people who already bought houses there 20 years ago can afford to trade their equity into another house and have that be very affordable because they've got a big chunk of equity that they can simply move to a new house, and they're only financing a small amount of that purchase price. It also doesn't tell you about foreign money. So, for example, in Orange County, we had lots of foreign money coming from the Middle East, from China, and from other places. And the Housing Affordability Index doesn't even know how to consider that. Right. So, depending on what index you're listening to or watching to try and predict where the market's going, you can make huge mistakes and have huge blind spots. And that's a pretty good index, actually. Case-Shiller would be far worse, in my opinion. Okay. I'm not a fan of the Case-Shiller index, but anyway, I just thought I'd share that.
Yeah, I would agree, but and also to your point, there's a statistic that I read saying that I believe for the first time in a long time, the percentage of individuals buying homes that are first-time home buyers are lower. And I think the quota statistic was that it's below 25%.
Yeah.
And kind of also to your point, right? I mean, even in the world of real estate investments, when we're talking about multifamily and commercial and, apartment complexes, there's a lot of 1031 that's going around.
Yeah.
And I don't know about you, but just in my personal circle of my network and my buddies, there's a lot more 1031 activities that I'm hearing, especially currently with people kind of moving their equity towards different assets. So,
right.
I definitely agree with you. And, in 2022, I think a lot of first-time home buyers are going to continue to be priced out by individuals who already have existing equity. I think there's also a statistic saying that the average American has more equity in their home now than ever, right? And a lot of people are saying, oh, this is like 2008, right? Back in 2020, a lot of people are saying, oh, it's '08 all over again. A lot of people forgot that, well, back then, a lot of people had multiple loans without a lot of equity, and those mortgages were very risky. This time around, a lot of people have a lot more equity. So
you're absolutely right. Yeah. The average homeowner last year increased their equity by $57,000. And I just put that on the screen for you. So $57,000 increase in equity. And here's how that's a 31% increase. That's $3.2 trillion in new equity that was created last year. So to your point, you're absolutely right. But guess what? There's even more. Of all of the houses in the country, 40% of them are free and clear. So they're under no threat of foreclosure. And if you want to see a market crash, you've got to have an increase in foreclosure activity, right? So the likelihood of any big bubble bursting, for those waiting for it, they're just sadly mistaken. It's just not going to happen anytime soon.
Right. Yeah. And I think there's a lot of people who kind of had capital waiting on the sidelines, hoping that something would happen. I think the most infamous one would be Warren Buffett. I think he had, billions and billions of dollars on the sidelines. So for you, Jason, in speaking of a recession, right, or speaking of a downturn, because, you and I, and you certainly have been around long enough to know that, hey, this can't last forever. There's just absolutely no way. So if there is going to be a correction or a recession of some sort in real estate, how do you foresee that happening based on what's happening right now?
You see inventory increase by about 500%. So as soon as there are 1.5 million homes on the market, instead of less than 300,000 homes, that'll be the first sign that we're at a normal market. That's only equilibrium, okay?
Yeah.
That's not a crash yet. And if interest rates spike and houses become very unaffordable, and that affordability index that I mentioned earlier does not, or if it declines, if housing affordability declines a lot, those things will be signs that things are definitely changing. But let me give you one other prediction that I think is important. And this is not like, it's not like quantifiable, like I can put a number on it. It's just an anecdotal prediction, but nonetheless, very true. We have created a situation, Daniel, where it's toxic, basically. These low mortgage rates that we've had for the past several years that got even lower, just insanely low during the pandemic, have created a toxic environment that will exacerbate the housing shortage for many years to come. And it will exacerbate the wealth gap and the inequality gap. And it's just going to create a lot of problems for many, many years forward. And that's this scenario. So tens of millions of people have refinanced their mortgage. Tens of millions of people have purchased homes. And they've locked in negative interest rates that are the lowest they've ever been, ever, in literally 5,000 years. There are books you can read, like the late David Graeber's book, Debt: The First 5,000 Years, which is a great book, by the way. I highly recommend it. That have interest rate charts going back to ancient Egypt. Okay, there's always been a cost of money. Okay, this is not a new idea, right? But now we have these low rates that literally are toxic to the system. And so when everybody has money where it's not only free, it's literally money you're getting paid to borrow, because the stated rate of inflation is about 7%, and the mortgage rate is about 3%, give or take. So you're literally, if you never rent the house out, if you keep it vacant, right? I mean, of course, there'll be some maintenance costs, some property taxes. It's minor, okay? Some, insurance, et cetera, right? But you're literally getting paid 4% to borrow the money by doing nothing. Okay, it's insane. These people are going to hoard those mortgages. And because the mortgage is attached to the property, it means that they won't sell the properties. So that's going to further constrict housing supply in the future, and it is going to make the shortage even worse. So that actually bodes against a market crash for many, many years to come.
Yeah.
Think about it like this. One of my team members, this guy has worked with us for about 7 years, lives in San Francisco with his wife. He has a rent-controlled apartment that he and his wife rented in about 1997. I had him on my podcast to talk about it. I think they pay like $2,400 a month. And they have been in that rent-controlled apartment since 1997, 24 years now, 25 years, basically. And their rent has only just inched up a tiny amount every year, hardly at all. Yet the price of that house is now worth almost $3 million, I think. Wow. They're paying $2,400 a month. Okay. So do you think they're ever going to move? No, no way. They're just going to stay put. So that creates a housing shortage. Rent control always creates a housing shortage in a black market. And these cheap mortgages are going to do the same thing.
Wow. So really kind of the only hope for inventory to increase then is for the cost to build to really go down. I mean, I mean, I don't know if I can see another way where, inventory can expand within the next 3 to 5 years.
The cost of land and the cost to build has to decline. And that would mean there has to be some sort of disruptive technology in the construction world, in materials science, that makes whatever you can build a home from much, much cheaper. And it's a low-tech item. It's not very disruptible, at least so far. I can't think, unless everybody's going to live in a force field or something, I can't see how they're going to disrupt it. It's not likely to be disrupted.
Wow. Wow. Yeah. And I think to your point as well is that's equally going to put a lot of demand on the rental housing market, or, the rent, not only just the single family rentals, but also with townhouses, co-ops, and obviously
Yep.
large multifamily buildings. One of the trends that I see a lot is a lot of the class A apartments being built nowadays with these extra amenities that get residents to stay.
Yeah.
I mean, a great example is my wife and I, we do pretty well for ourselves, but we choose to rent.
Yep.
And our rent is pretty high, because
Yeah.
we live in Chicagoland area.
Sure.
But, I told my wife literally 2 nights ago, said, honey, if we renew our lease for another 15 months, I actually wouldn't mind. They've got a great gym. They got a pool.
Yeah.
I mean, they have all these amenities that
super convenient.
super convenient, and,
Right.
and, to your point, I think a lot of that is going to be the future in terms of these, communities where these amenities are great. The community is awesome. And it's pretty sizable, for us. I mean, our apartment is, I believe, around 2,500 square feet, and
Oh, that's great. Yeah.
we have all the space
Fantastic.
we need. And I don't see us having a reason to move, to be honest.
And you don't have to worry about anything. It's all the landlord's responsibility. So that's good. But the way people listening have to hedge that. Look, there's nothing wrong with renting your own home. I've recommended that for years, that you rent your own home as long as you own low-priced rental properties that you rent to other people. Okay, that's the thing. That's the way you hedge that. You don't have to own your own home. Just own real estate that's investment real estate, so you're in the game and you're getting a good return on your money. That's the only important thing.
Right. And which we do, right? We definitely, my wife
Yeah.
and I have our fair share of rental properties that we do own. So now, before you leave, is there any last thoughts, comments, feedback you would give to our listeners? And of course, we'll have to have you back. But until then, anything you would like to say?
Yeah, I just, we didn't have time to talk about something that's a really hot topic for my audience. And, go to my YouTube channel and check out the Hartman Comparison Index. This is really a way that you can understand the real estate market and the value of real estate by answering what I call life's most important question. And that is, compared to what? And if you look at the price of housing and you compare it to gold or oil or a whole host of other assets, it's actually pretty cheap historically. And also, if you compare the mortgage payment to a whole host of other assets, property is actually quite cheap, contrary to popular belief, because everyone out there measuring real estate is measuring it by only one thing: dollars. They're simply comparing the price of the house to dollars. And dollars are really sort of a moving target and a meaningless measuring stick, because the value of the dollar changes all the time. In fact, officially last year, it changed by about 7%. It declined in value through inflation. And in real inflation, I would argue that it declined by about 15% last year. So to only measure real estate against one thing would create a huge potential for very bad judgments. And that's why I encourage everybody to check out the Hartman Comparison Index. It's on my YouTube channel. It's on my podcast. And I've even got a free white paper on it. If anybody just goes and gets on our mailing list at jasonhartman.com, they'll be mailed an opportunity to get the white paper. It's about 17 pages long that goes through all of this stuff, and it's totally free. So just check that out, and it's all there for you. Okay.
Yeah. And by the way, I love the fact that you said real inflation, because if you go to a grocery store, you get gas, there's no way it's a 7% increase.
Yeah.
It's more than that. The dollar store is now the $1.25 store.
Yeah, I know.
So I'm glad you said that. But yes, absolutely. Obviously I'm a big fan of your channel. So if you're watching this, I would highly recommend checking it out. There's very few gentlemen I follow that I make their content as part of my daily habit and my regular weekly kind of just schedule. And you are one of them, sir. So,
well,
you are part of my daily listening schedule that I listen to and I follow. So absolutely, I would highly recommend our viewers go check out your channel as well.
Well, hey, I appreciate it. Thank you so much. And keep up the good work you're doing for your community and your audience, because I love it. Whenever I watch your videos, I really enjoy them. And I know they love it too. So I just want to say happy investing to everybody. Thanks for having me on.
Yeah, absolutely, Jason. Thank you.